Excellent. Okay, so let's get ourselves sharing the webinar. We're going to be whizzing through this webinar today. So thank you so much for joining us for the 3 essential tools for business success. I'm going to just hand over to Ali, who's our moderator today.
Hello everyone, so we'll be doing the 3 essential tools for business success today. My name's Ali Bamark. I'm one of the senior account managers at Panthera Accounting. So it's nice to see everyone today. I will be looking after obviously all the questions. For those of you that haven't used Zoom before, the webinar environment, you can use the Zoom settings, so we'll take a closer look. So you can select your audio settings to test your speakers. You can also submit question and answer questions, via the Q&A button at the bottom, and we'll answer those questions at the end of the webinar. And if you click leave meeting, you'll be able to leave at any time during the webinar. Okay, so what I'll do today, I will hand you over to today's presenter. This is Tory Wagg, who's the founder and CEO at Panthera Accounting. So welcome, Tory.
Brilliant, thank you so much, Ali. And you know, guys, if you've got questions as we're going through, Ali will pick them up. If it's something that's pertinent to what we're talking about, she might interrupt me and we can just have a quick question. That's fine. Very happy to answer questions as we go. But if there are things that we might be able to delve into a little bit more, we'll hold those for the end. And we can go through those at the end. So do start thinking about anything that crops up while we're talking. I'd also really recommend that you take notes as you go through today. It's really useful to write down your thoughts as you go along, and then to have a bit of a review after we finish. So we'll make sure there's a little bit of time at the end today for you to do that review and make sure you can work out what you're going to take away from today's webinar. So I always like to begin with a thought for the day. And this one is from The Rock, Dwayne "The Rock" Johnson. So the thought for the day today is success isn't overnight. It's when every day you get a little better than the day before, and it all adds up. There is no magic bullet for business success. It really does take hard work, and we watch people do this in our client base day by day. However, using the tools at your disposal can drive hugely rewarding improvements. It's not about making drastic changes. It's about making really small incremental changes, changing old habits to get a little bit better each day. So before we get stuck in, I always say this, if you've been on one of my webinars, you'll be bored of me saying this, but I just want to throw in, we have a disclaimer. The information is educational in this webinar. That means it's general in nature and it's no substitute for tailored advice specific to your particular circumstances. And I always say that because there's nothing like actually explaining what's going on in your own business to a professional and then saying, actually, this thing isn't appropriate for you, but that thing is. So always make sure that you do reach out if you've got any specific questions. So the agenda for today, we have got 5 things on the agenda. It's not a massively heavy going webinar. We're not going to get stuck into spreadsheets today, which I'm sure you'll be pleased to hear about on a Monday. So we're going to talk about, starting off, we're going to be talking about the power of 1% and how small changes add up over time. Change isn't easy. We really know this. We've dealt with so much change over the past couple of years. And so one of the things I want to look at today is having the courage to make changes. We're then going to take a deep dive into the 3 essential tools and examples of these in action. So some really practical tips. And then we're going to look at what the next steps you should be taking and answer any questions that you've got. So let's start off at the power of 1%. Let's look at what we mean when we say small changes add up. If you improve by just 1% each day, after a year, you'll be a massive 37.8 times better off. It's really hard for us to get our heads around this. Human beings are very good at thinking of things in a linear process. We are very bad at understanding compounding. So take this as an example. If you increased your sales by 1% each day for a whole year, by the end of the year, you'd be selling 37.8 times more every day. So what would your business look like if you increase sales by 37 times? It's kind of like mind blowing, isn't it? It's a really big question. And it doesn't seem logical, I think, to the way that the human brain works, that if you just do 1% a day, it could make such an enormous difference in your business. So let's take, for example, those of you who might be in manufacturing. Think about what your business would look like if you could lift production by 1% consistently. Or think of it the other way around, if you could reduce costs by 1% continuously. What this formula demonstrates is the long-term benefits of continuous improvement. Of course, it's really unlikely that you'll achieve 1% growth in sales or 1% reduction in costs every single day. The point here is to illustrate the power of compounding growth. Even if you achieve 1% improvement, let's say each week, you would double in just over 16 months. That's really not very long. That's less than a year and a half. So we're simply looking to achieve continuous and sustained improvement. And it's that bit that's the real magic. It's doing it over and over again in a sustained and sustainable way. So now let's consider what happens if you don't make those changes. So let's say your competitors sharpen their game, or you fail to keep track of changes in technology, or you manage your team ineffectively because you're so busy. We hear this an awful lot from people. I'm too busy to make the change. And what will happen then is your sales would start to reduce, let's say 1% every day. So if your daily sales are currently £1,000 a day, and your sales regressed by just 1% every day, it's a really small amount of difference, your sales would be just £30 by the end of the year. That's kind of terrifying, isn't it? £1,000 down to £30 by the end of the year, just by not looking after your business. For those who are manufacturers, what happens if your efficiency decreases by 1% per day, or your costs increase unchecked, for example? Again, your sales or your production is unlikely to drop in a linear way like this. I mean, you'd really have to have taken your eye off the ball for that to continually happen. But the important point is that unless you make continuous improvements, your business performance is likely to drop over time. And I think this is especially pertinent just now because we're seeing inflation at a rate that many of us as business owners have never ever seen before, or saw a long time ago. And when you've got inflation that's got that same sort of compounding effect, if you don't take changes now in order to negate the impact of compounding, you're likely to be decreasing in value rather than increasing. As Einstein said, compounding is the greatest mathematical discovery of all time. And that is a big claim from a very, very intelligent man. So if you can just spend a little bit of time thinking about compounding and how incredible the effect is of sustainable improvement, you're going to really take some good stuff away from today. Change is inevitable. We all know that, right? Nothing stays the same. And I think the last 2 years has really shown that to us, that you cannot avoid change. If you're not making changes yourself, change is going to happen to you. Change is inevitable, but growth is optional. And we know change isn't easy. Thinking about other businesses that haven't adapted to change and what the impact has been on them, let's have a quick look at that. So why change? Kodak became the poster child for companies who failed to react to their changing market. In 1976, Kodak claimed a market share of 85%. That's enormous, but they failed to adapt to change. And by 2003, their market share had diminished to just 15%. Kodak actually developed the first digital camera, can you believe it? But they worried about the effect going digital would have on the sale of camera films, which was a really core part of their business. Their failure to accept the change from film to digital had a massive impact on their profitability. Now, most of us just carry a camera in our pockets all the time, instantly uploading photos to social media. By the way, Kodak actually released their first smartphone in 2017, so really not that long ago. At the height of its success, Blockbuster had over 9,000 stores worldwide. So this is another story of a business that had the opportunity to change, but didn't see the value in changing at the right time. In 2000, when Netflix was starting out with a mail DVD rental service, the CEO approached Blockbuster to discuss Netflix handling Blockbuster's online business for them. However, he was, according to Forbes, laughed out of the room. In 2004, so just 4 years later, Blockbuster finally set up their own mail DVD rental service. When the CEO of Netflix mentioned that Blockbuster had thrown everything but the kitchen sink at Netflix in order to compete with them, Blockbuster sent the CEO a kitchen sink the next day. Netflix now has over 150 million users. Last time I checked, Blockbuster had just one remaining store. What those examples of disruption highlight is that change is not easy. Even some of the biggest names in their industries haven't managed to deal with change effectively and have ended up disappearing off the face of the earth. When we're riding the wave of success, it can be really hard to see the need to change. We all have inbuilt habits and behaviors that we repeat. We also have so much going on in our lives that it's hard to start doing something different. There's always something else that seems like it's more urgent. What I'm showing you today is the formula for change. It will help you increase your ability to change. So if we start on the right-hand side, we've got this capital R. It stands for resistance. This is what's stopping you from changing your behavior, and we'll feel the effects of resistance in all sorts of areas of our lives, both personal and business. Resistance comes in three forms. You either have no money to do something, you've got no time to do something, or you don't see the benefit of changing your behavior. You need to build up the left side of the equation so that these variables are greater than your resistance. So what does the D stand for? Dissatisfaction with the status quo. You need to understand the consequences of not changing your behavior. What happens if you don't learn how to grow your business or improve profitability, as an example? So profit may drop, you might not be able to take your family holiday, you may have to get rid of some team members. Then we need to have a vision. What will your life look like if you do change your behavior? What do you want your future to look like? Do you want to have more holidays? Do you want to have more money? Do you want to be able to take more time off from your business? Do you want to spend more time with your family maybe? Having a clear vision will help drive you to change your behavior. And if you've been on our Visions and Values workshop, for example, you'll have seen us really delve into that. Finally, what are the first steps that you need to take in order to achieve that vision? We depict this with a lowercase f, you'll notice, and that's to represent the fact that the steps are small and easy to take. They must be bite-sized. Remember, the consequences of inaction will heighten your dissatisfaction and cause the business to regress. The fact that you're here today means you're open to change, which is amazing. So that's a really great step in the right direction. So the three essential tools I'm going to show you now are the first steps you need to take to start moving towards your vision of a positive future state. As you'll see from this formula, your resistance to change has to be outweighed by your dissatisfaction with the status quo and your vision of a positive future state. So what are these three essential tools for business success? So this is in my view, and we share this throughout our client base, and they are an annual business plan, an annual forecast, and ongoing reporting with accountability. And that little with accountability is really important. We're going to cover that in a little bit more detail later on. So your business plan is your guiding document to deliver the business outcomes that you've always dreamed of. It's not just a dream, it's got some really meaty parts to it, but it's something that you can follow. Your annual forecast shows you the numbers you need to achieve those desired business outcomes. And very often when we're making a business plan, we also talk into what your personal outcomes need to be. It's really important that your business is delivering on your personal needs as well. Ongoing reporting with accountability means regularly monitoring your results and having someone hold you accountable for completing your actions and achieving your goals. So let's take a closer look at each one of those. There are literally thousands of books and articles on the internet about the components of a business plan. It can get really confusing if you spend lots of time having a Google around this stuff. So here's what I consider to be best practice. The first thing is a clear purpose. So this should be maybe 5 to 7 words in a statement that explains why your business exists, and really importantly, why it exists for your customers. So taking it from that viewpoint. The second is a clearly articulated vision. What will your business look like in 5 years' time? And you really need to spend a bit of time with your thoughts on this. Where do you want that business to go, and what exactly does it look like? And I find things like a vision board, doing some mind maps around this is really helpful. You want to get creative when you're setting out your vision. 3, what do you want to achieve? You as the owner of your business, what does your business need to deliver to you? Remember, your business is there to serve you and not the other way around. State the hours you want to work, the holidays that you want to be able to take, how much money you want to make. And if you start there, you can then work backwards to see what the business needs to do for you. The next part is a high level budget. I don't mean getting down into the nitty gritty on how much you're going to spend on, I don't know, software subscriptions each month. It's really that top level. It helps to identify your gross revenue targets, so how much sales you need to make for the year, and it's based on what you've recorded in the what we want to achieve section. The budget also forms the basis for essential tool number 2, and we'll come to that in a bit. The 5th element is key performance indicators, sometimes called KPIs. You'll probably have heard this terminology before. Key performance indicators are the things to measure that will make sure you're on track to achieve your goals. For example, they could be something like, how many sales do I need to make each day? How many widgets do I need to produce each month? What gross profit should I be aiming for? Or even the number of days team members are achieving their individual targets. I would say choose a maximum of 5 and make sure they are measurable. When you're thinking about key performance indicators, very often we see people borrowing other KPIs that they've seen being effective in another business, but they haven't linked them back to what it is that your business needs to achieve for you. And that's where it sometimes goes wrong, because you're missing out on the relevant part of the KPIs. They must be relevant to you and your business, and they must be the drivers that when you think of them like gears or levers, when you turn them up, they come out with the right outcomes for what you're trying to achieve at the end. So make sure when you're setting your KPIs, you need to just do a sort of sense check on them. If I increase this KPI, do I get more of what I want at the end? If the answer is no, it's the wrong KPI. So number 6, opportunities and vulnerabilities. Your business plan needs to identify these so your goals can maximize the opportunities and mitigate the vulnerabilities. It's really, really important we do that. It's kind of like doing a risk assessment on your business. Like, where are the things that could go wrong and how can we prevent that happening? And it's what helps us to sleep well at night. It's what takes a lot of stress out of running a business. And the opportunities is that exciting creative stuff. What haven't we utilized yet that could really open up some new opportunities in our business? And sometimes trying to get to the bottom of what those are needs an external influence, maybe a mentor, a coach, an accountant, to help you really open up the opportunities that you might not be able to see in your own industry. And then the last part of the business plan, number 7, goals for the year. So you need to make sure these goals are measurable and achievable. So you can't be setting these unicorn goals, we sometimes call them, things that are plucked out of the sky. I'm going to make £5 million next year, when at the moment you're making £100,000. You need to make sure that there's something that you can hit, because there's nothing worse for your mental situation than not hitting goals. It's really important right at the beginning of goal setting, especially, that you set goals that you know you can hit, so that your brain gets used to the idea of you being someone that achieves their goals. Once you get into the habit of being a goal achiever, you can start stretching them out. But I'd always say set yourself some easy goals to start with so you can get some quick wins on the board. Your goals should cascade into 90-day goals. So you start with an annual goal and then you say, right, let's bring that down to 90 days. That's a nice quarter. And as accountants, we often think in quarters. It's a really nice way of chunking out the business year. So cascade them down to 90-day goals with clear actions and a person responsible for each action. So every goal should have, what is it that I need to do? How do I know if I've achieved it? What's the date by which I need to achieve it? And who is going to do it? A really good tip here is those actions don't all have to be done by you, the business owner. If you've got other people in your business, make sure that you share these goals around. If you maybe have contractors, outsourcers, somebody like a VA that helps you in your business, make sure that you're using them as much as you can in order to achieve those goals. It's really important to also review your business plan regularly to ensure the actions are being completed by the due date, and update your 90-day goals each quarter. So your business plan isn't this static document that you do once and put away. It's something that is a living and breathing document. You should be running your business by it. So there are some rules we follow when it comes to developing a business plan. And I think these can be really helpful if you're doing it yourself. So firstly, all key decision makers should be involved and complete pre-work before the planning session to reflect, prepare and be heard. We recommend using an independent facilitator to avoid some people dominating the discussion. If you've got some of those characters in your business, you'll know who they are. And you need to encourage alignment between stakeholders and key team members. Stakeholders can be a number of different people. So it's anybody that has a stake in the business. It could be your shareholders, it could be directors, company secretaries, or your senior management team. And they need to make sure that those are being fed back down to the key team members. Why we say we think you should reflect and prepare before you have your business plan meeting is that it allows those people that are maybe a little bit more introverted, who take a bit more time to think about things, to really prepare and come with everything they can to the meeting. If you do have a bit of an imbalance in your stakeholders between those more flamboyant or more loud members of your stakeholders and the quieter ones, you really don't want to lose out on the amazing insight that those quieter people can have. So giving everyone an opportunity to plan beforehand really means you can get the most out of that business plan session. We think your business plan should be on one page, double-sided, but on a single page. There's no point developing a massive 30-page business plan if it's just going to gather dust in a drawer. It needs to be visible at all times to guide your decision making, and it needs to be really accessible. Share your plan with your team, even if you need to remove some of the sensitive information. Quite a lot of our clients don't want to tell the team what it is that they want to take home. I would encourage you to be brave and try that if you can, because once you open up those conversations about why it is you're trying to make these changes in your business, you can really win your team on board, because they want the best for you as well, and they want to know how they can help. So if you can break through that barrier of thinking some of this is really private, then that's wonderful. If there's stuff that you don't want to share, that's understandable too. You don't have to put everything out to your team. It does encourage your team to buy into your vision and align their goals with yours if you can do it. You need to report against your plan on a monthly basis to monitor your progress. And I would suggest doing this with a monthly team meeting, monthly planning sort of meeting, just to make sure that you're staying on track. You should be reviewing and updating your goals and your actions every quarter at least to ensure you're on track to achieve those annual goals. So having that quarterly board meeting can be really helpful there. And you should be doing a full review and update of your business plan every single year. There's no point in doing it once and then putting it away. The world, as we know, changes really, really fast. Imagine looking at your business plan from 2019 and comparing it to your business plan for 2021. Very, very different circumstances. You need to make sure that your business plan is adaptable and ready to take into the changing world around it. Some things like your vision and your values might not change at all, or they might want a bit of tweaking, but take the time to review every single section to make sure it's still giving you what you need for your business. So what does this one-page business plan look like? I've got an example here for you. We've just got it for FO Limited for the year ended 31st of March 22. So all components are clearly identified. We like to keep things simple and easy to read and understand. So we've got the purpose, we've got the vision, which is what we want to achieve, and we've got the values section at the top. So you can see really clearly, we've here got £100,000 of profit. I want to be working less than 40 hours per week. I want to have 4 weeks of annual leave, and I want to take a family holiday. And those are definitely the business owners' personal goals in there, as well as the business goals. And it's really nice and clear what it is that we're trying to achieve there. And then we've kept the values in: dedication, continuous improvement, respect for the individual, and fun. These are really nice values, and you might want to think about what those values are in your business if you've not got them written down. Next up, we've got this high level budget. You can see it really doesn't have a lot of lines to it. We update the year-to-date column each quarter to ensure that we're on track. So you can see we've got an annual budget, and then we've got the first quarter and the second quarter all filled in here. And we've got a gross revenue target, a gross profit target, and a percentage in there as well, gross profit percentage. And then we've got how much we've got to spend on overheads, and therefore what's our net profit going to be. Now, these aren't massively complicated figures, and it's definitely something that your accountant should be able to help you do. Next, we've got the key performance indicators. So this is what we're going to be measuring. You can see we've added targets for our KPIs, so we know what we're aiming for. Our ideal client and value proposition are clearly identified. These should be shared with the team. So on this particular example, we've got our ideal client being a trade business servicing residential or commercial property, in business for more than 5 years, and lives into our core values. I really like that in this one. So we've got the values already on this sheet, and then we can see that our ideal client needs to live into those values, needs to really respect and value them, because that's how we work in the best way. Just having a quick look at those key performance indicators. So you can see we've got average weekly sales is more than £61,000. So it's very specific, and it's easy to see if we have hit that key KPI or we've not hit it. So it's easy to know if we've managed the targets. And we've got a couple of other things in there. So you can see, as I suggested, 5 KPIs max, perfect. Gross profit needs to be over 25%. Labour utilisation rate needs to be over 70%. That's really about, are we making the best use of the people that we're paying? Average revenue per client, £4,500 by proposal. Really easy to see if that's right or wrong, because you can just check your proposals against your KPI. And acceptance rate, that's your conversion rate, how good we're doing at getting proposals accepted by potential clients, needs to be over 65%. Our value proposition for the ideal clients here: local knowledge and networks, value-adding ideas and opportunities we can share, and project costs agreed in advance. And that's a really nice one. You know, those kind of value propositions help us to explain to our best sort of clients, our ideal clients, what it is that we do that makes us special. So getting that value proposition right is really nice. So we then have our opportunities and vulnerabilities. And then we've identified our most critical challenge. So in this one, we've got some opportunities that we've noticed: capturing more work that's going out of town, improving the sales skills of our team, or improving the workplace culture. These are all opportunities to grow your business. And then in the vulnerabilities, these guys have pulled out the overloaded owners. Gosh, how often do we see that from our clients? Owners trying to do too much, and actually it makes the business really vulnerable, because if one of the owners, for example, gets unwell, burns out from the stress, there's suddenly a big hole in the way that the business is being run. And it's really important to recognize what those vulnerabilities might be. Another one they've pulled out here is weak cash flow. And then on the most critical challenge, so out of all of the things that they've found as risks in their business, this is the critical one. They need to lift their gross profit and overall profitability without blowing the owners apart. That's a really common challenge that we see here. And once that's put down on your business plan, it's written down on a piece of paper, and it's something that you're going to look at regularly. It really helps you to focus on what the big picture is and what it is that you need to be fixing in your business. So on the back page, we record our goals and actions. So this is the second page of the business plan. So first up, you determine what your annual goals are. So this particular plan has got improving the gross profit to 25% and lifting the sales to 2.8 million. And you can see how that 1 year goal fits in with the critical challenge that they're trying to deal with. Then you break down each goal into 90-day goals. So each of these goals should be a step towards achieving your annual goal. So for this one, it's complete full review of financial systems and KPIs and have a new reporting system in place. Then you work out the actions you must take in order to achieve those goals. And then we're doing, so it's really specifically action-based. What are the things I've got to do in order to get there? And then we record who's going to do it and by when. And we recommend setting 3 to 5 goals for the year. This ensures they're achievable and you've got time to focus on each goal. So that's the first tool, your annual business plan. Has anyone got any questions? Ali, I'm just wondering if you've got anything in the chat that's got questions about it?
Well, so far there's no questions come up just yet, but obviously if anyone does have any, feel free to pop them in the Q&A box.
Super, fantastic. So that's what your business plan would look like when it's completed, and then you'd have this lovely document that you can just refer to. Some people, we know, laminate them and keep them on their table for their board meetings, so they can always come back to it, but it should be a working document. Okay, on to the second essential tool, which is the annual forecast. In the past, you might have prepared a forecast because the bank asked you for one, but it's something that should happen every single year. If you don't know how much money will be coming in and out of your business and when, you can't make informed decisions. So even if your business has got a positive cash flow, you should still be preparing a forecast. It can help you unlock a lot of cash just by making a few changes. And we often find that the thing that clients say keeps them up the most at night is cash flow. Your annual forecast will break your high-level budget from your business plan down into your monthly targets, accounting for seasonality and allowing you to predict and prepare for large cash outflows. Things like your corporation tax bill, a big spend on plant and machinery, needing to buy a new car for the business, all of those sorts of things, they need some planning around them so that you can be certain there's enough cash in the business to still cover the day-to-day spending that it needs to do. There are 3 types of forecasts which we can combine into something that's called a 3-way forecast. Now, you might have heard people talk about a 3-way forecast and thought, what on earth is that? I'm here to help you understand it. The first forecast is a profit and loss forecast, and this shows you whether you're going to make a profit or a loss each month. It gives you the flexibility to allow for seasonal fluctuations instead of lumping all the income and expenditure into one annual total. It could show that while some months you may make a loss, overall you're going to make an annual profit, or even vice versa. And what's really nice about having a look at it on a month-by-month basis is you forecast out over the whole year. And very often as business owners, we can get really caught into the minutiae of what we're seeing in our accounts, especially when we've got tools like Xero, so we can look at our P&L at any time. We might look at it, how am I doing this month? It's really good to be able to step back and say, I knew that May was going to be a weak month for us. It's fine. August is coming up and that's going to be a bumper month. And it helps you just to deal with the peaks and troughs of the profit and loss that's going on in a much less stressful way. What's really important to understand is that the profit and the cash flow are not the same. If you can take one thing away from today, I'd really hope it's a better understanding of the difference between profit and cash flow. Some costs don't appear in the profit and loss forecast. I'm just going to stop and say that again. Some costs don't appear in the profit and loss forecast. So you need to make sure that you're going to make sufficient profit to cover your additional cash costs. And I think this is one of the areas that makes such a big jump in business owners' understanding of their financials in their business, is when you suddenly go, aha, my P&L doesn't tell me the whole story. As soon as you can get past that P&L thinking, a whole world starts to open up. So that brings me into the cash flow forecast. This shows all movements of cash in and out of your business on a month-by-month basis, and it allows for those cash payments that don't show up in your P&L, like tax payments, asset purchases, and selling assets too. And an asset is something that might be plant and machinery. It might be spend on a big website, if that's an important part of your business. It could be the tools that you need to do the thing that you do. And you can buy in those kind of assets, and you can also sell them on. So for example, you might buy a new van for the business. You need it in order to get out to see clients. And then when you're done with the van, you sell it on. And both of those transactions wouldn't show up in your profit and loss account at all. The other things that affect your cash flow: drawings. When you take money out of the business as a business owner, as a dividend, that doesn't show up in your profit and loss account. And then other things like loan drawdowns and repayments. So we've seen lots of bounce back loans, CBILS loans, and those kind of influxes of cash coming into businesses over the last couple of years. Doesn't show up in your profit and loss account, has an enormous effect on your cash flow. So hopefully you can start to see why the cash flow forecast is a really important addition to looking at your profit and loss forecast for the forthcoming year. While the profit and loss forecast shows you your business efficiency, the cash flow forecast shows you whether you have enough cash to survive and thrive. Cash is the oxygen for the business after all. And we say this so often, but you can make a loss in your business time after time. You can only run out of cash once. Once you've run out of cash, that is the end of your business, which is why it's really important you keep a view of what's going on with your cash flow. And then the third and last forecast that we talk about in this three-way forecast is your balance sheet forecast. And that shows you whether the overall value of your business, sometimes called your net worth, is increasing or decreasing. So it measures your assets, your liabilities, and your equity. And your assets are those things that the business owns that have got some value to them or help it to make more of the thing that it makes. Your liabilities, that's who do you owe money to? So that could be the bank, it could be your suppliers, it could be HMRC for lots of different taxes. And the equity, that's what goes in your share capital and the retained profit that you've made over the past years. And it shows whether you're solvent or insolvent. Highly profitable companies can and do go broke, so the balance sheet forecast gives you an early warning of risk. For example, if you've had a massive increase in sales, but you're very slow at collecting your debtors and you're slowing down, you could end up in a position where you can't pay your bills as they fall due, even though your profit and loss account is telling you that you've got a very successful business on your hands. As you can see, your forecast tells you a lot about the health of your business. And this is why it's one of the 3 essential tools and why you must do it annually rather than only when the bank asks for it. It's a tool for you to use as a business owner. It's not just something to send out. Okay, here are our rules for developing your annual forecast. There is plenty of software out there to help you create a forecast if you want to do that, something in the cloud like LivePlan, for example, and you should be able to do some of this yourself. When we're preparing these for clients, we send out pre-work to complete before we prepare forecasts with our clients. And that's to ensure that they've identified all of their expected income and expenses. That's the sort of information that's often wrapped up in a business owner's head. And unless we start to delve in there and ask them some really deep questions, we don't always get to the bottom of what's going to happen. So it's really important that you spend some time as a business owner thinking about what's going to happen in the future and really getting that out in an articulated way. You start with your desired profit, and then you work backwards to calculate the sales that you need to achieve in order to obtain that profit. And then we compare that to last year's results. So is your desired profit realistic and is it achievable? And then we review those figures and make any required adjustments. And it's really that bit that sometimes people find tricky. Accounting is so often thought of as just a backwards looking data gathering situation where you look at the data and it's either right or wrong. Forecasting is very different from that. So it's more about building up a picture from the information that you have got and then tweaking it to make it as likely as possible. And we know that it's never going to be spot on, never ever is, because we don't know what's going to happen in the future. But something is better than nothing when you're coming to forecasting. And so we always try and say, let's just let's just get something down on paper. Then we can talk about, does it seem realistic? Does that seem likely? Have we ever managed to do that in the past? What are we going to do differently if we've not managed to do that in the past in order to make that happen now? And then year on year, our ability to forecast well for each business gets a little bit better. We learn from our mistakes from the year before, and we start to tweak it into getting a forecast that's really reliable. Of course, we can help you develop your forecast and identify areas where you can improve your cash flow if you feel like this isn't something that you can do on your own. So the third essential tool for business success is ongoing reporting with accountability. Reporting means regularly monitoring your results to ensure you're on track to achieve your goals. If you're not measuring your financial results and the key drivers of your business, you cannot properly manage them. Technology provides you with real-time data these days, things like Xero, and Xero is our preferred accounting platform, but we do know people use other kind of cloud accounting platforms now. But it does allow you to get really informed decision making done, because you can see what's going on in your business, normally up to yesterday with the bank feeds as they are now, and it's absolutely real-time information we're working with. You can compare this real-time data against your forecast and then make adjustments if required to stay on track to achieve your goals. So, if you've said this quarter I need to hit a 25% profit margin, but you're actually running at 22%, that means that you need to tweak your behaviors. It may be reducing costs, it may be increasing prices in order to get back to that percentage that you need to achieve in order to get those outcomes we've talked about at the beginning, making the profit that you need to make, being able to take time off as a business owner. So all of the monitoring that you're doing has to feed forward into that. We would recommend preparing management reports on a monthly basis to measure your key performance indicators. If you just wait until the end of the year to review your annual accounts, the data is too old to be of much use. It's all in the past by that point. By producing regular reports, you can quickly respond to any unexpected changes in your results during the year. So you don't have to get to the end of the year and go, oh, what a shame, I've hit 20%, not 25%. I'll have to do something different next year. Well, if you're reporting internally on a monthly basis, you can watch for those tweaks straight away and make sure that you do hit your annual goals during the year. Of course, without some accountability, you're much less likely to take the actions you need to in response to your reports. So people often start with really great intentions. We see this a lot. You can put lots of effort in at the beginning, producing your reports for the first few months, and then you get busy with your day-to-day stuff. Something happens, you fall off your normal monthly process of running your reports. Next month, you haven't got anything to check it against because you didn't set any goals for the month, and then suddenly you're back to where you were. Your accountability coach will ensure you dedicate time to review your numbers and check that you've taken the actions you need to. Accountability helps you to set aside time to work on your business and complete the actions you set in your business plan or respond to your regular reports, building better habits for your business. So an accountability coach must be someone independent, and they must have the backbone to give you consequences for inaction, but also the heart to really care about you and your business. They can't be afraid to upset you when you need a dose of accountability, and they need to care about you achieving the goals that you've set. Sometimes we suggest you buddy up with another business owner and switch accountability. If you don't want to be spending out money on this, that's one way of getting some accountability in your business, especially if you're a startup and you're being really lean. That's one way of doing it. Accountants make really great accountability coaches because we have this tendency to really understand your figures and know what it is that you need to do in your business in order to get there. You also need to have clearly documented actions with those due dates to ensure you've got a deadline to work towards. And there's got to be consequences if you don't take the action that you need to. So if you keep failing to complete your actions, something is broken and it's likely you've got the wrong person holding you to account. So who do you need in your business to hold you accountable? It's a really good question. If you've got one thing that you're going to take away from the end of today, let's think about who your accountability coach could be. So my aim is to help you take today's message and then implement some positive changes in your business. So what are your next steps from here? Doing nothing is not an option. I always say this on my webinars. It's brilliant that you've taken time out of your business today to come and listen, but if you don't do anything with it, it's been a waste of your time. So doing what you've always done is unlikely to give you the same results as is likely to give you the same results as you've had in the past. How are you going to change that? Make a clear plan that you can articulate to your team, and do that. Make sure that you've shared it with somebody, because as soon as you put your plan out there into the world, it makes it so much more likely that you'll actually take action. The next thing is to develop your forecast for the year and then repeat it annually. You need to find someone to hold you accountable, and you need to focus what you can do as opposed to worrying about what is out of your control. And very often that's where people get stuck, is that they go, oh, I can't finish this off because I don't have the right tool to write a full cash flow forecast. Put that to the side. Could you get started on your business plan today? Could you just do that top section and think about your goals for the year, making a start? We are here for you and we want to help. All of my team love helping people with these kind of issues. It's something that we're really, really happy to talk to you about. So let me just tell you a little bit about how we can help you. So there are a few tools that we have in our toolbox here. One of them is that one-page business plan. So as an example, if we're to do that process with people, and we do that with clients and non-clients. So if you've got another accountant and you just need this business planning section doing, we do that for people too, and we're really happy to. It's normally a 4-hour process. Depends on who's involved. I just caught Ali's eye because sometimes we take a little bit longer than 4 hours because there's so much to talk about. But it's around 4 hours. You often get 2 people from my team working alongside you on the business plan. You get all of your pre-work, and the aim is that at the end of that 4-hour process, you walk away with a 2-page, one front and one back page business plan that you can really take action on. And we charge that £1,250 plus VAT. I put all of the prices on here because we like to be really clear about what we charge. We have fixed fees. You pay exactly what you're expecting, and there are no surprises when you work with Panthera. And we suggest that you do a business plan every single year. The cash flow forecast on its own is £695 plus VAT, and that would be spending some time beforehand writing out your cash flow for you, then having a meeting with you in order to get that all pulled out together, and we give you the forecast to put forward for the forthcoming financial year. We do the accountability coaching for lots of our clients, and we start that from about £115 plus VAT per month if you're doing quarterly coaching with us, and it goes up depending on the size of your business, what sort of turnover you've got, and the sort of reporting that you're after. We can also help you with management reporting and getting that out of Xero, because very often we find people are very good at putting information into Xero, but they don't know how to get those management reports out, and we can help you with that. We also have free options. We've always got free options for those people that don't have the budget to start doing some of this stuff, but we want to get you onto the train of getting towards building a better business. So we've got a Building Better Habits worksheet. It's really, really useful. It doesn't take too much time, but it really helps you to take some action from what you've learned today. That's an absolute freebie. All you have to do is just pop into the chat, let Ali know, and we will email that out to you. And if you're watching this on a catch up, if you just drop an email to us, and our details are in the webinar slides. So if you just drop us a quick email, we'll happily send that over to you. And again, we always do complimentary meetings. So when we have people who aren't quite sure where to start, we offer a complimentary 1-hour meeting. We can talk about your goals. We can find out how we might be able to work together to help you to achieve those. And we're always happy to do that. Fantastic. So there's been a lot of talk from me. I'm just going to take a quick breather and see if Ali's got anything from the chat for questions. If you've got any questions for me, please pop them into the chat right now. And Ali, I'll just quickly let me know if there's anything while I take a sip of tea.
That's fine. So we have got one question that's come through. So whether or not we have a business plan template which we could share with our clients.
Yeah, okay, so we're very happy to share these slides as soon as we finish, and you can see that there's that template in the slides. And it's got the examples in there. And I think there's something really useful about seeing how somebody else has filled that in. So we can make sure that you've got that after the end of this session. So if you just want to let Ali know your email address, we'll make sure that the link to that gets sent out to you. We're all up for people using templates. Definitely, if somebody else has written a good plan, you can piggyback on the back of it. That's fantastic. Just be aware that you've got to then do it. And what we very often find is that people have really good intentions at the beginning and then they don't follow through with it. So if you want us to hold you accountable to doing that, again, just drop a note to Ali now and we can send that over to you, and in a couple of weeks' time, jump on the email. We'll just send you a quick nudge and say, have you done it? If you want to share it back to us and we can take a quick look and say, that's ace, but I would just tweak these things, or have you thought about changing the wording in your values to this? Always happy to do that. We're really, really keen to help as many businesses as we can with this. Anything else on there, Ali?
No, so that's the question that's come through. I know we've got a few others, I think, that we've had more commonly one. So yeah, if you're happy for me to hand back over to you to give a bit of information to them.
Yeah, fabulous. Thanks so much, Ali. So very often when we are talking around this 3 essential tools area, people ask us, what's the difference between the year-end accounts and the management accounts? It comes up loads. So I thought I'd just quickly run through that. So your annual accounts, that's your end of financial year accounts. They're the ones that have got to be prepared in order for you to stay compliant. They go to Companies House and they go to HMRC. And they are backward looking. So they say, after the end of the financial year, this is what happened in the past. They are very useful documents. Don't get me wrong, you've got to fill them in. You've got to get those filed. But what they don't allow you to do is make changes as you're going through the financial year in order to get a better outcome at the end. Management accounts are normally produced monthly. Some people do them quarterly, but I would always suggest to do them monthly. And they are your profit and loss account and your balance sheet. So again, don't just do your profit and loss account. You do need to look at your balance sheet as well. So P&L, balance sheet, statement of changes in equity, you might want to also look at. So that's the bit that shows where the dividends fit into what's going on between your profit and loss account and your balance sheet. And then things like your aged payables and your aged receivables. So aged payables, sometimes called trade creditors report, that's how much do I owe to my suppliers and how old is that debt? And your aged receivables, the other way around. So how much money is owed to me by my clients and how old is that? And when you're doing your management report pack, I'd say you've got to have at least those in there, because that starts to give you a more full view of what's going on in your business. One proviso against goes along with that is that you shouldn't just be looking at your P&L in it just for the month. You should be looking at what's happened over perhaps the last 3 months is comparatives and against your forecast. So you want to have your actuals and what you thought was going to happen and what the difference is. So that's what starts to make management accounts so much more valuable than your year-end accounts, because your year-end accounts don't say what did we think we were going to do and what did happen. They just say what happened. Your management account should say, this is what we thought was going to happen, this is what did happen, and therefore what are we going to do next month to make the difference? And that's what makes them really valuable. Cool. Okay, another question we get asked quite a lot is, I don't think I'm quite ready to do a big business plan just yet. What are the triggers that mean I should be doing this? How do I know when it's time for me to start doing that? And we often get asked this question by sole traders or people who are maybe running like a contractor type of business. It's just them and they are working for the same 2 or 3 clients on a really regular basis. They kind of know in their heads what's going on in their business and they feel like they've got control just like that. Some of the trigger events that I would say mean you should definitely do a business plan. You should be doing forecasting now. Taking on your first employee, bringing on another director or another shareholder into your business. If you've got plans to grow your business, or if you feel like you're stuck or trapped in your business, if any of those sort of resonate, I think that's a really good time to be starting to write a business plan and a forecast. And the reason being, you know, once you first take on an employee, suddenly all the stuff that you know in your head, you're having to share with somebody else. And you don't have absolute control of everything in your business anymore. And I think it's at that stage that you need to put on, sometimes say, put on your big girl pants and start running your business as a grown-up business. And that's not to diss what it's like to be a sole trader or a smaller business. It just needs a different sort of handle. And if you're going to grow your business, you should be putting those really good habits in place right at the beginning, because it's much easier to start writing a business plan for a small business than to not do it for the first 10 years and then start writing it so much further down the line. And it should really supercharge that growth. So it should be a document that helps you to achieve your goals. And the last question I had was, I already run management accounts from zero. Do I really need to do a forecast as well? So the difference between running your management accounts and doing your forecasting, sometimes when people say they're running management accounts, what they mean is they've got a budget written into Xero. If you're not using the budget manager in Xero, it's an absolute game changer. If you don't know anything about it, ping Ali or I an email. We can show you how to find the budget manager first. Xero have hidden it really well, but it's a really great tool. So talk to us about that. But let's say you're running your management accounts and you've got a budget in. Do I really need to do a forecast as well? Yes, you absolutely do, because the thing that Xero doesn't do very well is cash flow forecasting. You can put in a sort of a budget or a forecast against your balance sheet and your profit and loss account, but you can't do cash flow forecasting in Xero. They have a little panel that says it's kind of cash for the next 30 days. It's very, very basic, and you need to know when cash is coming into your business over a longer term. So I would say, yes, absolutely. Cash flow forecasting it's a real life changer. That's coming from an accountant. It sounds a bit extreme, but my clients that have started doing cash flow forecasting do say to me, I have no idea how we coped before we had this. So definitely you need to be forward looking, using those forecasts, because they give you your targets, they keep you motivated, they make sure you're on track. It's all part of that accountability. Ali, have we got anything else that's cropped up, or have we finished our Q&A?
No, so I think we've got covered. I have just popped into the chat box for anyone, both my email address and our accountant's email address. If you do have any queries after today's webinar and you think, oh, I wish I'd have asked that one, you can ping us over an email on accountants@pantheraaccounting.co.uk. But I think that's all the questions that we've had.
Super, that's wonderful. Thank you so much. So I always finish up before we let you go with a parting thought. And my parting thought for today is action is the foundational key to all success. You've got to take action in order to move forward. So I'd ask you to commit to at least 3 actions that you're going to take as a result of today's webinar. Write them down now. Give each of them an owner and a completion date. Remember that you don't have to put your name against every one of those actions. It may be something that you can delegate. And also remember that if you need our support, we are absolutely here for you. We just love helping small businesses to get some of this stuff implemented. It's a real passion of ours. So do reach out. We'll be very happy to help. So it just leaves me to say thank you for making the time to attend your webinar. I know how important people's time is right now. People are really, really busy. So I do appreciate you coming and giving me the benefit of your time. Please, could you complete the brief exit survey following this session so we can continuously improve and get your feedback on what other webinar topics you would like to see from us. And I really do hope I've given you plenty of ideas to think about and some really clear next steps for you and your business. So I'm just going to take that opportunity to thank you once again, to say thank you so much to Ali. It makes such a difference having a moderator alongside me when we're doing these things. And thank you for sharing your questions with us. And we hope to see you at our next webinar. Cheers.